Hi, Mark Oswald, your host for Londonderry, Heart, Home, and Soul. And we're continuing this series about home purchases and buyer financing. With me this evening is Nellie Dowdy and JJ Sawicki, both with Merrimack Mortgage. Nellie is a mortgage loan officer, and JJ is a area VP. Assistant VP, I'm sorry, of third-party lending.
Yes.
See, I know I couldn't fit that all on a business card.
Yeah, I know. You'd be surprised.
Thank you both for coming out.
Thank you.
Thanks for having us.
I'd like to address first the difference between pre-approval and pre-qualification. There's a lot of confusion in the market, and most particularly among first-time buyers.
Okay, I can take that one.
Yep.
Okay?
Most borrowers, when they come to you, they want an idea on what they will qualify for a purchase amount. Ideally, as a realtor, you would want somebody who is pre-approved. So pre-qualifying is when I sit with the borrower and I take their information, and so it's based on all of their verbal input, what they're telling me, possibly, probably a look at their credit, and then putting it together. We do have the ability at a pre-qual level to give a letter just to say that I have looked at it, but I'm not the ultimate authority. I can't issue a true credit decision as to their ability to obtain the mortgage. And so what's encouraged in the industry and what most realtors want and really should have is a pre-approval. And the way that a pre-approval is obtained is that in addition to pulling their credit and working with possible products that they might be interested in, is taking their credit information, their W-2s, their pay stubs, their asset statements, and collecting that along with an authorization for that to be reviewed and everything verified with an underwriter. So it's a hard pre-approval, and what that does is that leaves it subject to only the other part of the transaction. There's two parts. There's the borrower's ability and creditworthiness approval, and then there's the property. So when I send a pre-approved borrower to you, that borrower is ready to go. They're ready to look at properties, which as an agent, I think last I knew, your obligation was to bring a ready, willing, and able buyer.
Correct.
So that's...
Right, and very true. And I think what I've tried to emphasize with buyers when I'm serving them is it's important for them. They need to go into this with confidence that they have the ability at a certain price point to purchase a home, be it a condo or a single family home or what have you. So a lot of times they're ready, fire, aim.
Yeah.
And I'm suggesting that you probably need to ready, aim, and then fire. So
And that's a good point. I didn't cover that. It also lets the borrower know. I mean, as a rule, many will come in and they're just squeaking. You know, they just can barely make to get into a price range that's a property that they want. But some will come in with a substantial income where they're qualified to purchase $1 million home, but they don't want $1 million home.
Right.
So you work with them on where their comfort level is and where they would qualify.
You touched on credit and a great deal of importance on that. Let's talk a little bit about how's a credit score obtained, what's a good credit score, an acceptable credit score, how can you improve your credit? I mean, that's a series of questions.
It's a lot of questions. I know a lot of consumers out there, they typically use a service to monitor their credit. There's multiple different services out there on the internet that do allow them to do that, and they issue them a credit score. It's important for consumers to understand that there are multiple different algorithms that are used when credit scores are developed. So if they pull a score through one of the service providers that they use, the chances of that score being different than the one that the mortgage lender uses is about 100%. So I wouldn't necessarily rely on the score issued by that provider. You'd want to make sure that you're looking at the score that's pulled by your lender. The range of scores that are available through the Fair Isaac model, which is what mortgage lenders use, range from anywhere from 300 to 900. Typically we see scores between 500 and 800. That's usually the median. We really consider anything below a 620 to be it's not a good credit score. Anything that's over 720, that would be considered a very low risk for us.
And how does that impact a buyer? So
In many
the
different ways.
difference between 620 and 720, what's going to happen with them when they go to actually finance a purchase?
If you have a credit score that is low, that's basically telling the lender that the risk on your loan is going to be high because historically, maybe you haven't always paid your debts on time. If you have someone that has a credit score of 720 or higher, really anywhere in the 700s, that's a representative of your entire credit history. So that's showing the lender your willingness to repay that loan.
Okay.
And just as an aside, every profile for every borrower is different.
Yep.
Many times friends will talk, well, I got this rate or I got that rate. And there's so many qualifiers that fall into that, credit score being a pretty significant one that
Yeah.
impacts.
And depending on your credit score, it can really depend on what kind of mortgage program you get into, which would be dependent on what rate you get.
Yeah.
So what do you want to talk about next? Interest rates or types of mortgages? Your choice.
Types of mortgages.
Okay, let's talk about types of mortgages. Why not?
Okay. So there's multiple different programs that are available to consumers, and it can get pretty confusing, especially with the ads and everything that you see on TV. But the most typical products that are out there are your conventional loan products, which are your Fannie Mae, Freddie Mac programs. You've got your FHA programs, which are done through the Federal Housing Administration. Your VA programs, which is really targeted just to veterans. And then you've got the rural housing products, which are targeted to buyers and borrowers that are living or looking to live in a rural community.
And so let's backtrack just a bit. What amount of money has to be deposited for conventional versus the other forms?
So for a conventional loan, they typically look for at least 3% down on those programs. For FHA, those require 3% down as well, but you don't have to contribute any of your own money. It can be gifted, which is a nice feature of that product. With VA, you don't have to put any money down. And with rural housing, you don't have to put any money down as well. So, and the nice thing about these programs too is they offer a variety of seller contributions that are allowed up to a certain percent. So for example, with rural housing will allow for 100% financing, no money down, and the seller can pay unlimited closing costs. So the borrower literally comes in with no money at all.
So before we go to interest rates, let's talk about PMI.
Let's talk about PMI.
We actually have somebody coming in to talk about that on another
Yes.
segment.
Okay.
We do.
We do.
We're going to touch on it a little bit, and then
Okay.
she
Just
can
a
go
little
into
bit.
some
Okay.
Just a
detail.
little bit.
So, the different mortgage programs are offered, obviously based on the risk of any particular borrower's profile, right? So with a conventional mortgage program, if a borrower is putting 20%, less than 20% down, they'll be paying monthly MI on that loan, and that's based on a number of different factors. FHA, they require a monthly fee as well. On top of that, they also require what's called upfront mortgage insurance, which is a percentage of the loan amount that can either be rolled into the loan amount or paid as a closing cost. VA doesn't have any monthly MI at all, but it does have what they call a VA funding fee, and again, that's a percentage of the loan, can be rolled into the loan or paid as a closing cost. Rural housing, they have a monthly amount that you do pay. That monthly amount is on every type of transaction under rural housing. And then they also require what they call a guarantee fee, and that's a percentage of the loan amount, and that's really based on whatever the loan purpose is, whether it be a purchase or they offer like an RD to RD refi program.
Okay. Thank you for the brief explanation.
You're welcome. I'm good at brief.
Thank
Details to follow.
Yes.
They have to tune in for another segment.
Yes, absolutely.
you.
Okay, interest rates.
Interest rates.
And you can't believe everything you see on the internet, right?
You can't believe everything you see or hear at all.
Right.
I know, sometimes when I'm sitting home at night watching TV, I see a lot of those commercials that have big flashy lights and, show these wonderful interest rates, but you really got to be careful. Interest rates are typically set by in eighths. So for example, 4%, 4 and 1/8, 4 and a quarter. So when you're seeing an interest rate on TV that is like, I don't know, 4.862 or something like that, they're not advertising the interest rate. They're advertising what's called the APR,
Right.
which is the annual percentage rate, and that includes the cost of doing the mortgage itself.
And so there's more than meets the eye when someone's quoting an interest rate.
Absolutely.
Oh, yeah.
All right.
Yes.
And so buyer beware, and what questions should they be asking?
Nellie, you want to take that one?
What questions should they be asking on interest rates? They should be asking, oh, my mind's gone blank.
They should be shopping around. I mean,
Oh,
I
right.
would definitely recommend that they shop around. Lenders do set interest rates differently, again, based on a number of different factors. Different programs have different interest rates, like I was talking about conventional financing,
Right.
FHA, VA, RD, and the market moves every day. So you really want to make sure that you are you're shopping around, you're really checking for the best product. And in addition to that, going back to what we were talking about credit, if we have a borrower as a lender where we might view the loan as a risky loan, you've got a low down payment, you've got a low FICO, no reserves, you might find that your interest rate is higher on that type of a transaction because it's based on risk.
Okay. What have we missed?
No. No,
Okay.
I think essentially,
Yeah.
I think we're
It's
good.
a lot of waterfront.
A lot of waterfront.
Stay tuned for more.
Yeah.
Thank you both.
Thank you, Mike.
Thank
Appreciate
for
you coming
having
out.
us.
And thank you for watching. Remember, as always, be of good heart.